Good morning, good afternoon, good evening, and welcome, depending where you are on the planet. And welcome to today's Wednesday, the 22nd of June, Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. We're going to go through this kind of a slightly delayed. Well, we're coming in half an hour later than we usually do, 30 minutes later. But we're going to go through our usual regular run through in here today. We're going to take a look at the calendar, what we've had, what we've got coming up. We'll take a look at some articles from the major news wires. What are the macroeconomic, fundamental, geopolitical events that are driving markets right here, right now? And then we will take a look at some charts. Okay, the main piece of data really this morning has been CPI data, inflation data out of the UK. Came in mostly in line with expectations. The headline number for May, 9.1%. It's going to grab headlines, 40-year high, but anticipated in line with forecast. The month-to-month data was slightly higher than anticipated. Previously expected, at zero point 0.6, but actually came in at 0.7. But do notice that month-to-month data massively down from the previous up at 2.5, right? So even though it's above forecast, it's way down on the April number. And they're not showing on here, but we did have the core PPI as well. The core PPI, the core CPI data, which the Bank of England does monitor. The core CPI data was actually lower than expectations, lower than consensus, lower than forecast. So that's obviously a positive. What we have seen on the back of that, the gilt market has gone slightly lower in here to excuse me. Let's start with the FX. The FX market initially went lower on the back of that. The pound selling off, and that's probably because actually the report wasn't quite as bad as anticipated. So it probably means a less hawkish central bank in here, even though there are inflationary pressures. If we take a look at where the gilt market went considerably up, notably, well, not aggressively, but notably up in price, down in yields, higher prices. But global bond markets have all pushed higher anyway in here this morning, so not necessarily just to do with what's going on in the UK. I think it's important, I said this previously, the UK is kind of a bit, not exactly, and I haven't done a deep dive on the data in here, but it's certainly the Bank of England was ahead of any other major central bank in hiking rates at the end of last year. They were the first of the major central banks to hike rates. As far as I can think, yeah, I'm pretty sure that's the case. And then we also had the UK data is running quite hot. The inflation data probably higher than most of major global economies. It's been running that way, probably ahead of some of those global major economies. Again, I haven't got hard data on this, but this is a little bit of intuitive. I've looked at the data, but I haven't done a big analysis on it. But certainly, it feels like it's running kind of at higher levels and also been slightly ahead, kind of leading where other data has gone. And for the fact that it's kind of starting to show signs of slowing down. Now, remember, the Bank of England said they now expect headline CPI number to 11% later this year. But it is showing signs of starting to cool very slowly in certain parts. So although the PPI data was actually quite, as you've seen here, the PPI data. So remember, this can affect the actual CPI data for down the line was above expectations. So that's a little bit of a concern in here. But again, cooling down, as you see from April. So the PPI number coming in at 2.1, expected at 1.9, but 2.7 previously. So all of this in here, the UK inflation report, I think, is a mixed bag, but maybe offering something to say that we are getting closer to peak inflation in here. Going into today now, what do you have? We get further inflation. That might be interesting to watch what we're getting out of the US cousins up in the north in Canada. So we have the CPI data coming out of Canada in just under half an hour's time, in 26 minutes at the moment. And then we do get Fed Chair Powell testifying to Congress. Now, that testimony is already out. It's come out at the end of last week, over the weekend. But it's going to be the Q&A that's going to be interesting. Harker is also speaking later today. And if you're trading oil, we get the regular weekly API crude stock data coming out today. Let's take a look at the events in here. 5 things you need to start today. Well, we had another report in here from an investment bank, Citigroup, saying there's 50-50 chance of in here a global recession, and probably maybe possibly a soft or softish landing is possible. What else are we having in here? Housing trouble in here. The property market globally is potentially wobbling. And what else? Biden in here calling on Congress to enact a gasoline tax holiday with pump prices in the US hovering around $5 a gallon. Stocks are lower in here this morning. So European stocks have been led lower, primarily by energy stocks significantly lower, mining stocks, commodity stocks significantly lower on concerns of global slowdown in here. So we're seeing oil significantly lower, and that's put and commodity stocks lower, and so energy and metals trade poorly. WTI and Brent crude just dropped over 5%. So we've had a big drop in there, but then that's not necessarily a big negative. Remember, lower obviously oil prices is going to be actually good for inflation. So that's, you could take that as a positive, right? But the market at the moment getting negatively impacted by that. Article in here, in UK inflation hits record 40 highest in G7. That's what I'm saying, is we are kind of leading the way higher. Food price inflation highest since 2009. And then the Bank of England previously predicted, already said that, the 11% in here. But some of that data is kind of mixed. Sterling was weaker against the pound. So yeah, it's going to be interesting to see how that goes. Obviously, we've got strike action going on in the UK this week, and potentially more, warning of further strikes as we go forward. And look, so Britain's headline inflation in May was higher than the United States, Germany, France, and the world champion again, yet to report consumer results for May. So, yeah, so we're, definitely the UK kind of leading as a lead indicator. And yeah, there were some signs in there of things maybe not be looking as bad. Futures are down, with European stocks lower in here this morning ahead of Powell's testimony. So that's going to be the key focus on the day. US futures fall with oil. So as recession spreads fear, again, focus on recession now. But this is just fitting a story, fitting the price action to there's no real story. Why are we looking at recession again when yesterday we weren't looking at recession? Okay, there's been no new news apart from really that CPI data out of the UK. So markets are flip-flopping between recession fears and inflation fears. So which of them is it, and why are we down today when we were up yesterday, right? So traders return to Haven playbook. So this is one thing. So bonds are up today. Okay, remember we kind of had this kind of started to get this divergence, this dislocation between bonds and stocks. Yeah, bonds have been rallying since the Fed, and equities continue to go lower. Okay, or have remained weak, and bonds have gone up, broken higher. I'm going to come and look at those on the charts. We looked at it yesterday, so it's going to be interesting to see how that ends up playing out, because you can't have it both ways. You can't say, well, higher yields mean it's more pressure on the higher yields, higher interest rates, stocks lower. And then when you get lower yields, go, oh, lower yields, bonds are being bought because they're a safe haven, right? So the journalists, it's kind of lazy journalism. It's kind of one or the other, right? It's kind of, we're either, you either want bonds up if you're a stock investor, or you want bonds down, right? And at the moment, the correlation, it's bonds go lower in price, higher in yield, and that's negative for stocks. And then bonds go up in price, down in yield, and that's negative for stocks. Well, why does it work both ways? So that's not necessarily the case. So bonds have broken higher today. With flag higher bonds should be positive for the stocks. And when actually look, since bonds have really been starting to push higher today, stocks have actually turned around, having sold off and actually started to rebound. What else do we have in here? Oil price buckles as a recession. So again, oil price going down because of recession, but lower oil price. Part of the problem we've got is inflation, which is being driven by higher energy prices. So that's actually, you can view that as a positive as well. S&P has an okay. This is just interesting headline. I thought worst first half of the year since 1970s. Okay, since the 1970 actually itself. So not great in here for the S&P 500, and with cryptocurrencies at the moment aligned with pretty much trading positively correlated with stock indices. The lower stocks in here today have seen Bitcoin sell off again, and still gripping around the 20,000 level, having flushed through there over the weekend and rebounded, but nevertheless, looking still vulnerable. What else do I have in here? You looked at that, some headlines: stocks and oil tumble, recession fears mount, everything we see. European stocks, led US futures down. And again, it's sliding commodity prices. Sliding commodity prices and inflation worries. Well, sliding commodity prices are going to reduce inflation worries, right? You can't have both of these, right? So, again, not the best journalism. So, where are we with stocks in here this morning? If you go and take a look at European stocks, you can see between 1 to 1.5 to 2% down, pretty much across the board. And if we take a look at US in here this morning, having added on about 2.5% yesterday, we're down about 1 to 1.25 in Nasdaq, nearly down 1.5 this morning. No real update on here. This is the CME tool, still nailing on. Actually, you can see in here, actually this has shifted. So this is actually now, remember the bar was on the other side in here with so this is here is pricing in the 75 basis point hike, and we did have a outside chance of a one, more than that. Now we've got chance of maybe only a quarter a percent hike. Sorry, a 50 basis point hike, but still pretty much nailed on that in the next two meetings we're going to get a total of a total of 125. So looking for 75.50, but there is risk of 275s. Let's take a look at some charts. So this is what I wanted to do a quick look at on the bonds. So bonds have actually broken higher, having consolidated through the beginning of the week. Not done, we've rallied after the Fed. So this is Fed day here. Okay, where are we? Last Wednesday was the 15th. So that's Fed day, that green bar there. Then it was whipsaw on the Thursday, and then since then we've consolidated. Friday and Monday we obviously semi-closed, and Tuesday a very narrow range. Okay, but then look, significant break higher in here today. And if you actually look at the timing of that, it's kind of been rallying in here since, and this is my time, okay, since last night, since after the US close, okay. However, the real impulse came from the European morning. We've had this push higher, and obviously European government bonds, well, not obviously, but European government bonds have gone higher, gilts have gone higher, UK government bonds on the back of that UK CPI data, European government bonds also going higher, and we've broken above previous peaks in here, okay. If we go back to the daily chart, you can see broken above those previous peaks that we saw last week. So that's positive. And really the acceleration is like coming from around 6:30 a.m. I'm just doing it on because it's on my time, 6:30 a.m. my time. So that's about, where are we now? That's like 7 about 7 hours ago, okay? In here, for the last 7 hours, the market's been ready. And you've got a real kind of another impulsive move since in about the last 3 or 4 hours. And if we go and take a look at what stocks have done, although stocks did sink initially in here through the early European morning, they've actually rebounded in here really as we've seen that acceleration since the mid-morning in Europe, since the acceleration. So they sank lower really with Asian stocks, and then that long bar there, that's the European Open. So European Open sent us lower on the stocks, but then since the bonds have been rallying, we've seen stocks rally as well. So the bond market rally is a positive. So this bond market rally here we're seeing, and then we're seeing here is a positive, and we're broken out. We're sending a really quite positive signal in here, and I do feel that there's that correlation needs to come back into play. So even though it's the S&P again, the S&P looks kind of negative on the daily chart, you do see in here there's the sell-off from like overnight, and then there's a sell-off after the close, and then overnight we're starting to get a rebound, and I think there is potential for the upside in here for stocks still, even though we've had that rebound, and it'd be really interesting to see how we go on the US cash market open. And obviously we've got the Fed testimony from Powell. And then you got to do your analysis on here, the counter trend line. The market's threatening that counter trend line. So if I get rid of all this old analysis, that's the thing that's important for me. This kind of down counter trend line, the market's already, if you can really draw for this point here, and you can see the market's already broken. It's a good trend line. You kind of get close to it here, moves away, moves towards it, impulsively moves away this morning. It's already reversed that counter trend line off the top. The next thing you'll be looking at, can it get above the Fibonacci retracement? Can it get above the 38.2? And it's fouled almost just below the 38.2. That's going to be around 37.28. So above there would certainly be a positive signal. And you see that little peak there? That's right on the 50%. So that's at 37.38.75. So 37.20, what did I say? 37.28 and 37.38.75 are going to be two key levels on the upside. But you can see if you actually put if you go over to even shorter time frame, you put this little uptrend line, market's breaking down through this one as well, so it's a little bit of a concern. So we're kind of hesitant in here at the moment. For me, there's still a little bit of upside risk to come in here. And I don't think, despite this setback, despite erasing Monday's gains, we are still holding on. Sorry, Tuesday's gains. We're still holding on to the gains from Monday. So it's going to be interesting to see how this one plays out today. I'd be very cautiously long. And again, similar story on there's the NASDAQ. And if we go in here, there's the NASDAQ. Go into back to the, where are we? So that's the failure. And then the rebound lower, and then the failure this morning. There's the sell-off from last week. The rebound, we looked at that, 38.2% retracement. The market couldn't get back up to there yesterday, and then back lower. And if we go into a 15-minute on this recovery, so there's the sell-off from overnight. Sorry, there's a fly in here. I'm not sure you can hear that. It's very annoying. So we haven't got through that trend line there, and you've got the more accelerated trend line on the NASDAQ. So the NASDAQ not making the same kind of bullish signal, and you've got that one there. So it's flirting with that trend line as well, not really quite making it. And if we look at the little recovery trend line just from this morning, just breaking down through there. So it's kind of hesitant at the moment. I'm still, I'm only 55.45 bullish in here. And if it starts to break down through like this little low here, down below 11,370 on the NASDAQ, it looks vulnerable again. So, yeah, I mean, at the moment, I think it's just wait and see how this develops. Let's take a look at gold and oil. I'll start off on gold because it's the least interesting. So gold's still paralyzed in this range in here. I've still got an underlying slightly positive bias in here, within that kind of choppy range that we've got. And you see this kind of impulsive move we've seen this morning sort of reinforces that, but it's very much coiled in here at the moment, really just coiling up in this kind of bigger triangle pattern. That's not going to be that used to us. You could say it's tried to break out, faked out to the downside, back up to the upside. Hold a gun to my head. I'm bullish. Very impulsive rebound in here. Held these lows over here. Solid rebound in here, and just in the last, last hour or so, solid impulsive move back higher. And it's swung back low, and you got an opportunity to get back in. So just waiting for this to bottom out and swing. As it starts to swing back higher, I'd be venturing along on gold. And then look at the oil, really big negative sell-off in here for oil, reinforcing the top that I've been talking about. Stayed bearish on this anyway. Little failure candlestick yesterday, wiped out supports. Your problem with oil today is, you've had the sell-off, right? It's done. It's kind of been there, done that. We've had the rebound. It's already rolling lower, So, prefer to be short here on oil, but has it done? Going back to that daily chart, has it done enough already on the day? We're very oversold on a daily, so we've already been oversold from this sell-off, and then you've kind of exacerbated that. And if we go in back to the oil chart, so 15 minutes we're corrected, but if I step out to like maybe, I don't know, a 1 hour chart in here, you can see we're still fairly oversold. So it's difficult to sell it when the market's moved, wherever it's dropped today, right? It's dropped 5%, like 5, 6, 7% or something. It's dropped from 109 to 103, 6 and 103. It's about 5%, right? And if you look at the candles on this chart, right, there's not many that are longer than this. We've got this one in here. So selling it right here, you're selling into the hole for today. You got, do have some big days like this, but generally speaking, this is a pretty big day. So, has it done enough already? So it's difficult to go short. I probably wouldn't touch this one. I think there's more opportunities elsewhere. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Stay safe out there, and I'm back with you with another bull versus bear webinar tomorrow.